Okay, so first of all, a very happy new year to all of you. And just write in a chat box that you can able to view the screen. Okay, so today we'll go through about the monthly market updates for the month of January. And as we see, the stock market Sensex is at 72,000 level. So we are at a very high level, presumably for a normal people to understand. But when you see the data, you will understand that where we are exactly and what the market will going to be from here from now onwards. Now, before starting, I just want to show you last slides of mine. Like this is an interesting slide. Like up to 1820, India had one third of the world GDP. If you see the graph carefully, India usually used to be, total world GDP is 33% used to be from India till 1820. Now, by 1947, it has dropped to a merry 4%. Now, after independence, it has further dropped down. Okay, so that's a very interesting data point. Another interesting data point I want to give you that till 1981, even in 1987, India and China's GDP was equal. So, and after 1987, China has grown drastically from 1987 till last couple of years. And today, India GDP is around 3.5 to 4 trillion, whereas China is around 20. So that's the kind of jump that China has made in last 20, 25 years and so. So now, as you can see, US and China top the list with 26 and 19% of the world GDP respectively. India presently occupies the fifth place with 4% of the world GDP. So that's the current structure we have as of now. Now, mention this in 1987, India and China was having an equal GDP share in the world. So we have seen what China has grown from 1987 till date and what India has down growth in those years. But what we are projecting, so this is the number of data that we have, like in 1981, $196.54 billion, which is equal to China's also. Okay. At that time, China was on 10th position in 1981. And you can see from there onwards, India's growth has been very stagnant. Albeit in the last 10 years, India has started growing, and which has been evident from the data point here itself. Now, what we are projecting, a lot of people are projecting is that India at 100, that in 2047, probably India at $3.5 trillion economy right now, it will probably reach at 35 trillion or 26 and 30 trillion. It can probably reach at 30 trillion, which will be like a humongous growth from here onwards. Okay, so many of the world renowned experts have already predicted this thing because of various factors which we have already told, and we are going to share a couple of this thing with you today. So India to be a 30 trillion economy by 2050 with a per capita income of $21,000. So SDFC Bank Chief Atanu Chakraborty has said India's middle class income will nearly double to 61% by 2046 to 47. And India to have a billion plus middle class in 2040. So these are the data point which we are seeing right now and the projection that we are seeing right now. So on a nutshell, if I going to tell you that on a long run, we have a very, very good prospect coming ahead. Now, let's see what exactly is happening in the world economy. The same structure we normally give every month presentation: global economy, US economy, Indian economy, and then Indian equity market, gold and debt market, what is happening. So today also the session will follow the same structure. So global economy will quickly go through. Central banks maintain their fine balance between growth and inflation. All the central banks are doing that thing. Central banks are making losses on bond portfolio due to rising yields. Bank of Japan paper loss on JGB holding grows to record 71 billions. So we'll quickly move on to this thing. What are the important data point here in the global economy is that central bank expected to cut rates in 2024. Now we have seen this in the last 3 to 4 years that inflation was at all-time high, and as a result, the interest rate in across the world is high. Now this is the month, this is the year when we are expected central bank to cut the interest rate globally. And what is going to happen with the interest rate cut? With the fund move to equity, sorry, like once the interest rate cut down, will the fund move to equity? As far the past record goes, yes, it has done to that thing. Now we have seen why the central bank will going to cut interest rate. You will be able to find out in my next couple of slides when I show you the US data point. The inflation number has cooled down, and as well as there has been a growth showing in the US economy. Now, if you see the emerging market to S&P 500 lowest since November 2001. So this is a data point, emerging market outperforming 1989 to 1984 and since lowest in 2001. Okay, so that is the data point which we are having. So this is so globally what we are seeing is that the two things happening. Don't get into too much of data point. One, we have seen there's an inflation cooling down, although there has been a geopolitical tension in the Europe and in the Middle East, but still we have seen the global cooling down of the inflations because the supply side has increased. Secondly, there has been a turnaround in couple of countries which we are expecting a huge slowdown post the COVID situations. And as a result, the interest rate, which have already been high in most of the global economy, you will expect to see a more aggressive stance from the central bank, and you will see a interest rate revival in 2020-24. So that's what is happening in the global economy. So one is inflation cooling down, and there is a expected central bank reversal of the interest rate. Now, what's happening in the US economy? Fed is maintaining a very delicate balance between growth and inflation. So this is the rate hike months in first increase. So this is a data point. US Federal raised total reserve. US Q3 GDP growth the fastest. See, this is the interesting data point. If you can see from 2021 till now, the US actually was degrowth. Now, this is the first time in Q3, like December quarter, US has grown very aggressively. Okay, this is the first time they have grown very aggressively in last 2 years. And those who have invested in US stocks, those who have invested in via ETF in US stock, you are able to see the kind of growth which you're seeing in your portfolio. Growth is supported by large fiscal deficit, no sign of fiscal deficit reducing meaningfully. US economy has cross rate. US government debt increasing at a fast pace, job opening are declining, US bankruptcy filing highest since 2020, US bank credit is contracting sharply. So US is growing, but there is a big problem is that there is a job openings are declining. Now their government debts are increasing. Now this actually comes to a point where Fed will have no other reason, no other options but to decrease the interest rate. Okay, so which we are going to see in a day. So US interest payment on Federal Reserve is greater than defense spending. US interest payment on federal debt is greater than defense spending. This is the first time in many years after 2000 they have gone through this number. So this is a huge data, and as a result you're going to see that US Fed will have no other reason, no other option but to decrease the interest rate. US market at crossroad. The super five make up more MSCI than Japan, UK, China, France, and now almost Canada too combined. Despite the rally, 72% S&P stock lag behind the index. Okay, so what that exactly means that the rally in the S&P which you have seen in a recent time in last 2-3 months is basically skewed towards couple of stocks only. Now, will Fed keep rates higher or for longer? Rate goes up by escalator, it comes elevated. So I very strongly predict that this year you're going to see the Fed rate, reducing. And when, well, we don't know. And that is the reason we have seen, one of the reason why we have seen that stock market is moving up. I always tell that stock market normally reacts 6 to 7 months in advance. So today at January, what we are seeing, that market is already factoring in 7 to 8 months of informations which we're going to there in the market. And what normally happen, people say that after elections, market if the election results is not satisfactory, market will move around here and there. So and after election, market will move up more. That is very unlikely, because election redress has already been factored out. Now what we are seeing, I presume, is that global interest rate movement which has been getting factored out in the market, and that's why a lot of monetary movement as far as the FII goes are happening. So you will see the data where I'm show you more about it. Now, talking to the Indian economy as a result right now, what are the headlines of December? Uh, Headlines of December, like Apple aims to make a quarter of the world iPhone in India. This is the big news. Apple aims to make a quarter of the world iPhone in India. India surpasses Japan, secured third spot in global auto sales. India's core sector growth falls to a 6 months low. India inflation rises to 5.6% in Japan. November. Indian manufacturer PMI hits an 18-month low of 15.5 in 9 in December. So mixed net direct tax collection jumps to 21% to 13.70. So mixed kind of informations coming up, where inflation has been a little bit higher up in November. Industrial growth is also high, where there is a huge tax collection which has jumped to 21%, where the core sector growth has fallen to a 7 point. So a mixed kind of information which has come up in the month of December. But Indian growth story is firmly on track. Projected rise of the Indian economy. So if you see the projected rise of the Indian economy, so India to become a US dollar 26 trillion by 2047. So this is a projected number. So currently we are at this level, so which is around 4 trillion. Okay, so by 2047 India is expected to reach as 26 trillion. So from 4 trillion to 26 trillion, so can you imagine, it is going to a six-fold, like seven-fold increase from what we are currently right now. And I always say that GDP and market capitalization go hand in hand. So if the GDP grows 6-7 times from right now, you can imagine the kind of market capitalization will also grow that much. So you can understand the kind of sensex movement in next 20 to 25 years, where it will be going to be from here itself. So in 2023, India leads the global growth contributor. So you see the biggest and sharpest and big icon is that of India. Moving on, India topped the emerging market tracker. So if you see all the market in the emerging market, composite index score, India is the highest. Real GDP growth, see the India is the highest. And if you see all data point, most of them are India is at the top notch corner. Economic activity above pre-COVID level. GST collection, it has been a consistently 1.6 trillion right now. Lakh crore right now. Economic activity is equivalent to a pre-COVID level right now. Consumption have subdued. FMCG coverage, volume growth has subdued. So that's one. So as you go through the data, you will find a mix of data information here. K-shaped consumptions, inflation, erratic weather dampen the sales of FMCG. Domestic air travel rode into 2023. PV stays on recovery tracks. Two-wheeler far behind. Credit card spend to hit an all-time high, which is evident. Consumer sentiment showing signs of recovery. I quickly move to current account balance is a comfortable. This is a good data point. And then we have investment in rising. Government is building infrastructure. It is evident. See the kind of government investment in infrastructure has risen like it's been huge in last couple of years. And capex cycle is also on all cylinder. So I quickly move through. Incremental credit output is improving. Real estate on multi-level high growth. So if you have invested, this is a year where you can see a huge rise in the real estate prices. Okay, so as far as the stock prices goes, real estate multi-year growth cycle. So we are predicting that real estate price, which was subdued for the last 7 and 8 years, probably will give a rise, not on the retail segment, but probably in the commercial segment. Banking system is well placed. Well, I don't have to tell about this. Oil prices corrected at the 12% since November, but we have seen a slight increase in oil prices because what's happening in in the ocean. The dacoits and Hayatis and all those stuff was going on in the Indian Ocean and Arabian Ocean. So this 75 number has quite sharpened up in last 10-15 days. But not to worry, a lot of governments are taking counterproductive security measures so that it can also even cool down. Power cut may return in summer. So thermal power plant. So what we are predicting is that this summer, coming 3 to 4 months from now, we're going to see a much more higher power cut. So that's a data point which is there. No plans for compulsancy, middle income trap, technological disruptions, good and bad. So what we are seeing in India is that freebie versus deficit, government total social spending. So if you see the number, welfare spending flat compared to pre-COVID level. So earlier, rural, this is health, this is agriculture. So earlier it was much higher. Now it has been more or less flat and subdued and balanced at. So in India, as such, what we have seen in India is we have seen the growth in number of all segments, bearing couple of segments which are here and there, but overall we have seen a major growth as far as the Indian numbers are coming now, which has been reflective of the equity market also. The year of a terrible market prediction. Now, one important thing is that this year, all the big market players have predicted Indian market to go down, but actually what happened is that market has returned with a 26% return. Okay, so always we rely on the data which has been there. Okay, so people will have different mindset, different intention of giving you expert opinion. So that's why we always present about you the data and let data speaks for itself. Indian economy and corporate India in a strong shape. So if you see this data point carefully, you can take a picture of this data and go through it, because if I able to explain it fully, it will take a long time. So nominal GDP CAGR, compounded annual growth rate, is 16%. See, from FY03 to FY04, and so this you see Nifty EPS CAGR is 19%. Nifty EPS CAGR is 25. So it has slowed down here and it has grown up here again itself from FY20 to FY2025 expected. So which will be exactly in a line of what usually happened in 2003 to 2008. And this is the 2 year where we have gone down. So which exactly is EPS, earning per share, and what the GDP CAG is happening. So that's what happening. What we have seen in the 2003 to 2008, we are seeing in 2020 to 2025 cycle itself. Earning expected to remain robust. Will market cap will follow? Well, I always told you in earlier presentation that market cap is always follow the earnings. So which is when their earning growth will be driven by domestic focused companies. Valuation from discount to premium. So if you see the valuation wise, Nifty PE is 1 year forward is 19.6, average is 18.5. So predominantly it's not very pricey. Yes, small cap and mid cap are a little bit costly. So if you see the small cap, forward PE is 21.5, whereas average is 15.9. So I strongly recommend that don't go out investing in a small cap companies right now. Obviously, there are some bottom-up companies which you can able to pick where the valuation are attractive, but in general, small cap should be a no-no. Same with the large cap, same with the mid cap, but large cap we have seen a pretty opportunity out there, as is trading at nearly 6 to 7% premium level. So that's what is 5 to 6% premium is normal, but small cap, a big no-no from our side. Don't invest in small cap in near future. Probably let the market be cool down a little bit, and then you can re-enter in the market. Or if you have a 10 years duration kind of thing, then you can go through. Market cap to GDP all-time high. So the data is there, which actually tells us that market will be volatile, and you can see some cooling off from now onwards. But the cooling off can happen not very recently, because I told you about the data point earlier that Fed may reduce interest rate, and if the Fed reduce interest rate, you will find a lot of FII flow coming into India, and that can boost Indian market again from here itself. So we don't know what exactly the Fed will reduce the interest rate and when the market flow will coming up, but the flow has started coming up. I'm going to show you the data. The FII flow is coming up again. Earlier it was not there, despite that, because of the domestic investors flow, market has gone up. Now imagine with the kind of FII flow coming up, where the market will go from here itself. But market cap to GDP is a higher side, which actually tells us that you need to play a very cautious approach. Don't put all your money into small and mid cap companies right now, but try a approach of a asset allocation or a large cap based equity investment if you want to do so, and that too in a staggered way. FII holding in equity at 10-year low. See, I told you FII holding in Indian equity as 10-year low despite strong fundamentals. So FII holding in India in 2023 is very, very low because of the higher interest rate in US and other countries because of the forex factor. Now, if the Fed reduce interest rate, this FII holding Indian equity will rise, and that will again boost our market to next level. I told you in our last slide also. Indian trades a premium to emerging market. I quickly move on. India's risk premium fallen sharply. Will investor bet on performance and valuations? See if you see the emerging market valuations wise, India PE is higher, current level last seen in USD. So if you see the valuation wise, India is costly than any other country right now. Okay. In emerging market, India doesn't look expensive on peg basis, but on a peg basis, India doesn't look very expensive. I move on. DI, I'm going to take on FI selling. I already told you that last year the FI used to sell a lot, but we don't have an impacted because of the strong DII flow. Actively managed mutual fund, 1,01,000 crore, balance advantage, SIP allocation. So there's a huge amount of DII flow coming up to the tune of 4 lakh crore every month. So that's why we have no any disadvantage if at all FI comes in and again pull out money from India. Okay, so if I had turned a net buyer, so I told you, if you see the last year data point, this is the India figure. Most of the FII have been selling, selling, and selling. Just from the month of November and December onwards, if I start buying in India, and that's why we see the market reaching the new high. Moving on, small cap and mid cap leads earning growth. I already told you small cap is at all-time high. Earnings upgrade, favor large cap. A market compilation, I am not going to take much time here because I've already told you about this. Flow into mid cap continues. Divestment in low budget estimate. So another point, this important data point, net inflows of various categories of domestic mutual fund in India. So if you see the net inflow, small and mid cap, we have the highest number of inflow coming up, whereas this is the large cap at the lowest number of inflow. So mind it, if you want to make money, you need to pull out investment in the large cap segment right now. Does divestment in below budget estimated? So what we are seeing that marginally overweight large cap, we already told you, equal weight mid cap and marginally underweight. So small cap, you can book profit, or if you have a longer duration, stay invested there. Mid cap, we have no, we have neutral, and large cap you can quick investment right now. Election year outcome performance, well, I already told you election year result has already been factored in the pricing, so don't worry about whatever results will come up. Yes, we obviously know what is going to happen in election, but in case any major change happen, then you can see a slight bit of fluctuation happening. So I am not going to go deeper into this thing on the election year thing. But what is there in the equity market? Global recessions place rates higher for longer, risk to earning trajectory, supply of paper. So rates, as I told you, we don't know when the central bank of different countries will reduce it. So that's the risk remain. As for the positive side, softer oil prices, favorable India macro election result as per expectation on software yields. So that's what is happening in the Indian economy. If you see the debt market outlook, I already told US yields are expected to come down because of the rate cut hike. 10-year expectation of Fed rate cut, I already told you about this. Fed rate steady, slowly, well managed. I just quickly move on from here itself. Liquidity shortage. So what's happening on the debt side is that liquidity easing, debt FII flow, RBI pivot, Fed rate hike, fiscal slippage, inflation, credit pickup, and liquidity tightening. So only one thing can happen here. It's that if the Fed think to pause the interest rate lowering movement, then you can see a market turbulent in the global. Otherwise, not. So that's what we are expected to see in the debt side. So if you want to invest in a debt also, go by investing in a bond, in a medium term bond paper right now, because if the rate decreases, the bond yields will go high in a reverse way, and you can make a good amount of money in a very short term. So invest if you want to look for a very secure kind of product. Invest for a medium term bond paper with a modified duration of a favorable modified duration. Okay. So gold, we are expecting see the gold kind of return, commodity return lower than the US. And one interesting data point, gold has delivered 12% CAGR since 2000. So if you see the gold kind of return, and we expect the return of gold to remain at same level because of China and Russia keeping up more gold reserve than expected. Falling Fed rate support gold prices. And one important thing is that the silver industrial demand is new high. The reason because is vehicle electrification, growing adaptation of 5G technology, solar industry using PV cell, urbanizing infrastructure. So if you have not invested in silver now, you can take a position in silver because of the following factors which I have told you here itself. Okay. Deficit in supply has supported silver price globally. So that's the I will recommend you that if you have not invested in silver, you can take a position in silver right now, but not more than 5% of your total asset. So I normally recommend that 10% of your asset be invested in commodities. So be it in gold, and now you can take some position in silver itself. So what's happening in annexure itself, I am going to show you a couple of data here more. If you see the global Nifty index right now, 5 years return, mid cap, small cap, Nifty and Nifty. So it is more or less similar return which we are getting in the next 5 years. But yes, in a short term, you are going to see the Nifty small and mid cap are higher performance. Sectoral index, if you see every year, the index actually performed. Last year, the realty sector has actually performed. If you see the 3 months performances, they see the Nifty realty index is higher. Every time, every year, one or other sector actually perform some way or the other. So you cannot actually choose one sector and to be perform every time, consistently over the 5 years. Like one sector will perform this year, another sector will perform next year. So what approach will be like, go with a flexi cap kind of approach. If you are investing directly to stocks, have a stocks which actually cater to different industry, so that you can have you can ride the bull in all kind of market condition, because realty has gone high this year. It is not high in last 2 years. So bankex was higher in last year. So every year the index, the sector actually perform differently, which is normal. Global, if you see the global index performances, so emerging market has been a staggered kind of thing. In last 5 months, last 3 months, Nasdaq has increased. I told you about US performances in last, last quarter was exceptionally high, and that was reflected in the Nasdaq itself. Okay, China has been in a declining space with -4% in the last couple of 3 months now. So moving on, sale to the market with diversified portfolio. This is the same thing. Like every year, you will see different industry and different sector to perform, and that's what I have already told you about this. Okay, India has done well in 2023. If you see summary of the global index and currency performances, India has done exceptionally well. You can take a picture of this and go through it later on. 8 consecutive year of positive return for the first time in history. So first time in history, the Sensex has given 8 consecutive positive return. But this data actually worries me because it can anytime be reversed. But good point is that we don't have much negatives in store, apart from the Fed decision of hiking or not hiking the interest rate. But that too will be countered by the huge DII flow that we are having. Oil and gas and financial only sector delivered 8 consecutive return. So I just mid cap and small cap. I told you a lot many times. FII have net turned buyer. I showed you the data in earlier also. So moving on, domestic MF witness heavy healthy flow in third year in a row. So which predominantly says that people are investing more of into Indian market than putting money into FDs and other kind of asset class. Power of DII, I already told you. Equity is a saving. Equity is a small percentage. Still, equity is a very small percentage of housing balance in India. Only 5%, and other physical asset 52%, and you can see the bank because 16%. So there are a lot of opportunity lies when this money will come to the equity in the market as the Sensex will perform from here. We already showed you that the GDP will grow and the market cap will grow. So once that growth will happen, you will see this 5% will increase more from here. That means more DII investments. IPO supply remains strong. So this is the IPO supply number of issue we have seen. We will continue to see huge amount of IPOs in days to come. Sensex is positive in 19 out of 23 years. So that actually says that if you have invested in stock market, people say it is risky, but here it's at 19 out of 23 years, Sensex is positive, starting from 2001 onwards. Significant wealth creation in last 18 months. We have seen a significant wealth. Micro cap is given 115, small cap 93%. So kind of run 1.5 years, you will see a money has been doubled in most of the in a sector in a small and mid cap positions. So India versus other global ranking improved 7th place in last decade. So if you see the India ranking, global ranking has improved in last 6 to 7 years. So another important data point before I normally, do you know that 2013 versus 2023 number of smartphone and annual value? So in 2013 was 19 million, now it's 139 million. So if you see all data point out here, we have seen a massive growth from in last 10 years. And imagine what is going to be in 2047 when the Indian GDP is expected to touch 30 trillion from the 4 trillion right now. So that's a sixfold increase from what we have. So here, whatever we have seen, probably you can see a humongous growth from here itself. So what this actually tells you is that you need to stay invested in India, believe in India, and when you choose market, when you choose sector, when you choose companies, that you need to think of, because small cap probably is higher right now. So go with a multi cap, go with a hybrid kind of or balance advantage kind of product, or go with a large cap product with a higher duration in mind. And even if you want to invest in small and mid cap, do a bottom pickup where their opportunity lies in that segment. Okay, so that's all. This we have already provided you details about it. So that's from my side today. Stay healthy, stay safe. So overall, on a nutshell, what I will going to say you is that stay invested. We are going to see the return that we are seeing is nothing if we consider 4 to 5 years duration in mind. But yes, 2024 will be volatile. Every month we're going to show you the numbers. FII, a Fed rate is very important factor. What they're going to do, because right now what are the FII flow in last 2 months? You have seen a huge FII flow coming in India. That's why the market has gone higher side. But the market cap to GDP is at all-time high right now. So this has happened because November and December until January also there are huge FII flow coming up. They are expecting Fed to go up their interest rate. I already told you that market behave 6 to 8 months in advance. But if FII do not, pause interest rate movement, or the election results come in a slightly different way, which is not expected of, then you can see a market jittery a little bit. But I don't see a market very much movement here and there from now onwards. But do not invest all amount your money into equity right now. Instead, go with a staggered investment. Stay away from small and mid cap as a general, but you can stock pick by a bottom up approach. There you can get some opportunity out of it. You can write back to me for more details about your investments and details. So keep following my monthly market updates. And one important information is that this month at 26th and 27th, I will be having a 2-day workshop on how to pick up stocks out of 6,000 equity stocks in Indian market by using fundamental analysis. Okay, so that's a 2-day workshop. It will be like 1.5 hours each. So it will be a 3 to 4 hour workshop. I'll be sharing in the link for registrations. Those who are interested can join there. It will be on 26th and 27th in the evening time, 8 to 9:30. So we will have a fun learning how to pick up stocks using various tools and techniques, doing fundamental analysis. Even a person who are not from the finance and tech savvy or maths background can able to do that using those tools and techniques. Thank you very much for attending today's show. So any doubts, any questions, you can drop me in my WhatsApp message directly. Thanks.